Good afternoon, everyone, and welcome to Park Edge Advisors Market Insights monthly update. I'm Matt Gordillo, a partner and financial advisor. I'm joined by Gavin Gowicki, portfolio manager, and Rich Lowry, partner and chief investment officer as well. First, a moment from our sponsors. All right, thank you, Rich and Gavin. Welcome. Happy summer to you.
Hey, Matt, how you doing?
Doing good. Doing good. Just busy year and lots of volatility and head fakes and so forth like that. And as you know, we keep a monthly piece that we do. I did get some feedback about some interpretation on it, so I thought this would be an opportunity. Gavin, if you could recap us from last month and where we stand from last month to today.
Sure. Really, from the start of this year, to touch on the point that you just brought up, Matt, we were thinking there was the potential for, let's just say, higher volatility than we saw last year. And we started to see that, obviously, as the first quarter progressed. From last month, we called out the potential for what we would call a quad 2 transition. Quad 2, if you remember, is a risk-on quad. Quad 1 and 2 are both risk-on, 3 and 4 are risk-off. So basically, after all of that volatility you just talked about, we said, well, hey, maybe there's this potential for a risk-on kind of transition here. And that's what we've seen. So here we are in June, and we were not surprised by that. And so that's kind of the update. Quad 1 and 2 are still in the lead, so we still have a risk-on, setup in markets. And so then the question becomes, does that stay, or does what we've also been keeping our eye on is quad 3, where growth slows, inflation accelerates. The dynamics there have changed a little bit. Maybe Rich will touch on that, but that's really the question now for the rest of June.
Very good.
Yeah, I'll just add to it that the bean counting of the economic data is going to show economic growth slowing, and we expect inflation to start ticking higher, let's say as you get into July. But in response to the tariff tantrum, Wall Street has taken their growth estimates down by so much that it's probable that they're going to have to revise growth higher over the next quarter. So as they revise estimates higher, that's going to look to consensus as growth re-accelerating, and that kind of gives rise to that quad 2 picture. So we are seeing it across our risk matrix, which is really the catalyst for us to adjust positioning.
Very interesting. So sometimes sounds like maybe a classic overreaction that the market and so many pundits love to do is happening. And reminds me of another saying, sell in May and go away, and maybe that doesn't apply this year. And that leads me to questions that we get from a lot of clients, which was on April 2nd, when President Trump infamously came out with his tariff scoreboard, so to speak. And the markets really sold off dramatically in that very short period of time, and have since recovered. And I'm just wondering, was that a tariff tantrum, or was that a legitimate correction? Some people even say we entered into a bear market and the bull market ended. But here we are now back to higher levels, not all-time highs yet, but was that just a blip tantrum to that news, or was there something fundamentally there? And maybe kind of what Gavin was touching on in the opening is just maybe we're in a different overreaction mode. So if you guys could shed light on that, I think that's been a common question since early April, as things have changed a little bit since April. So any comments you have on that would be appreciated.
Yeah, well, the media likes to use kind of arbitrary 10% as a correction, 20% as a bear market type of thing. But to us, it's all conditional. If we were still sitting in a quad three, I would say the odds favor us going back and testing the lows. But we've climbed out of that. We're right now quad one and two are in the lead, which is risk on. And I would just say, as long as those conditions prevail, the odds favor higher. We won't retest the lows. Now, that doesn't mean we won't retest the lows sometime later in the year. What I'm saying is, as long as we're in quad one or quad two, it's unlikely that we test the lows during that environment. If we do get a change in conditions, then, it's like, all right, game on. Those would be the conditions under which we would look to retest the lows. But at least for the time being, we're not seeing that that's imminent. On the market insights report that we send out, we have a 3 to 12 month outlook. Think of those as kind of the weather forecast. Do you expect the regime to change in the next 3 to 12 months? And if so, is it going to be a positive or negative direction? Right now, that's saying positive. Remember back in January, that flipped bearish in January ahead of the risk off phase transition to quad three that happened, during March. So with the risk matrix pointed to a risk on environment, and with the forward outlook 3 to 12 months being positive, I would say we're not expecting us to retest the lows until the conditions change. And that doesn't seem likely in the next 1 to 3 months.
Excellent. Gavin, anything to add to that?
No, I would just also bring up the idea for clients to think about, which Rich and I have discussed quite a bit, which does piggyback on what Rich is saying. But that let's think about the equity markets, not just here domestically, but around the whole world. And I think, what we've hit on so far, and listeners can go and read the market insights just to get the takeaways here. But think about, what type of equities are you owning? Is it just 100% domestic? And if so, then the question should be right now and for the rest of the year, which we've addressed in our portfolios so far, what other countries might be appealing? Because we're in these conditions where if they persist long enough, they're almost reinforcing where the dynamics of flows, even if it's a small shift away from the US, could be a big impact in some of these markets around the world. And some of the data in Europe and in different places has been strong. So it's not, just an equity market that's only the US. We have to look everywhere. And that's a question that we're asking this year.
Yeah,
Very good.
I think that's worth some emphasis. Gavin calls out a very important point. If you look at the spread between domestic and international over a long period of time, 10, 12 years, US has handily beat the rest of the world. And we've mentioned it on prior calls, but the cumulative impact of all these trade deficits is that we're sending money overseas. We get goods and services, and that shows up as a trade deficit. We send money overseas to pay for it. And the cumulative impact of that is it gets recycled back into dollar-denominated assets to the point that foreigners own $26 trillion more of US dollar-denominated assets than Americans own of foreign assets. It doesn't take a big reversal of that to create outflows from domestic to international. And 26 trillion is, certainly big enough that even a modest repatriation of that capital, it could provide a tailwind for international investing. We're saying at least through this year, but it's a large enough figure that it could be for, several years. And, think about how most portfolios have been constructed over the last decade. They're probably underweight international. And it's kind of ironic as we're pursuing an America First agenda. We could be setting up for a rest of the world outperform US kind of climate for years to come.
That is very interesting, Rich and Gavin. And, one thing I know is a primary theme here at Park Edge is to actively manage risk. And so that's a prime example of actively managing it, not only just domestically, but internationally is a form of managing risk. And so appreciate that insight and more to come. But it sounds like what I'm hearing is change can happen, and we'll be ready for it. But for now, times are good, and it's time to celebrate the summer, and let's enjoy, at least for now, the risk on Quad 2. And we'll get an update next month and see where we stand then.
Sounds good.
That's great.
Okay, guys, thanks so much for your time. We'll talk to you next month.
All right.
Thanks,
Have a good
Matt.
day, Matt.
Take care.